Welcome to the Learning Pines YouTube. We hope this video helps.
You start by collecting what you need and taking immediate action. Pull 5 years of income statements, balance sheets, and cash flows. Make sure the share count includes options and convertibles. Choose a valuation path, discounted cash flow for intrinsic value, comparables for market context, or asset-based for balance sheet focus. Once done, normalize earnings for one-time items and adjust for non-cash expenses so your inputs reflect sustainable performance. You now construct projections and translate them into cash. Forecast revenue growth and margin drivers for 5 years, then derive NOPAT and free cash flow by subtracting CAPEX and working capital needs. Include depreciation add-backs. Choose a discount rate, WACC if valuing the firm, required equity return if per share. Discount projected FCFs and a terminal value back to present. Make sure to scenario test high and low cases to understand sensitivity and drivers of value. You complete by aggregating results and converting to a per share figure. Add discounted cash flows and terminal value, subtract net debt, and divide by diluted shares to reveal intrinsic share value. Then cross-check with market multiples and comparable companies. Reconcile major differences. If numbers look off, troubleshoot by stress testing assumptions, lower growth, alter margins, or adjust WACC, and pinpoint which input drives the swing. Make iterative corrections until results are stable and.
Thanks for watching. Consider subscribing if we helped you.